Hi, finance experts. My name is Breanne Bias, and today I'm going to be talking to you about my sell-sided report. And basically, what I did over this report is I found 5 companies that were in the healthcare industry, and we pulled some numbers. These numbers came from Bloomberg. And basically, what I did was I analyzed each company for its market value, profitability, and also solvency. I looked at its current ratio, cash ratio, quick ratio, its financial leverage, total asset turnover, profit margin, return on equity and assets. I looked at, its price earnings ratio, its price market to book ratio. I looked at all of these things, its EVA spread, to analyze which company would be best for me to invest in, which company was more attractive to me. And, usually when a lot of investors are looking to invest in a company, they're looking for who outperformed in an industry. Well, what I did was I looked for the company that I found most attractive based off the company that would be that I found to be most profitable, and a company that had room for improvement, but also room for growth. So I'll just get started on like the companies that I picked. How did they perform against one another, and why did I pick the company that I chose I would invest in? So what I did was I dealt with the healthcare industry, and I have 5 companies. So basically the companies that I analyzed over a 5-year period would be Stryker, Abbott Laboratories, Johnson & Johnson, which is a very well-known company that we use on a day-to-day basis. It's very well-known. It's a very diverse company. Medtronic, and Penumbra and Company. So basically, I'll just tell you from the jump which company that I found to be, most attractive, most profitable, the company that had the most room for improvement, but also the most room for growth. So I chose Johnson & Johnson, which is obviously a part of the healthcare industry. Its symbol is J&J. It is exchanged on the New York Stock Exchange, and its current price is $146.21. So basically, I'll just give you a rundown of Johnson & Johnson. So Johnson & Johnson is one of the biggest and most leading manufacturers that produces, things such as baby products, beauty products, and also offers healthcare products worldwide. And that was outside of its ratios and how it performed, was also what made the company very attractive to me, how diverse its product line was. Johnson & Johnson not only deals with the Johnson & Johnson brand, but it's things such as Benadryl, Tylenol, Aveeno. This is brands that we're dealing with on a day-to-day basis. So for me, I really looked at these numbers for this company, because I wanted to know how the products that I'm using on a day-to-day basis, how is this company that I'm always buying into and buying its products, how is it performing year-to-year basis? Now, how is it handling its assets, its debt? How is it paying off its liabilities? I wanted to know all of these things about Johnson & Johnson, excuse me. So Johnson & Johnson, we'll just get straight into the numbers, had a cash ratio above 1 for four out of the 5 years that I analyzed this company for. So compared to its competitors, one of the top competitors that Johnson & Johnson was going against the companies that I pulled was Penumbra. Penumbra's cash ratio was 0.86, and it increased to its highest or its peak at 4.29 within this 5-year period from 2013. So Johnson & Johnson had a current ratio which was consistent between 1.83 and 2.5 within this 5-year period. It didn't go below and it didn't go above, which was highly attractive to me because, it showed me that Johnson & Johnson can pay a short-term debt. So I found that, that ratio to be very attractive compared to its competitors. It led as far as current ratios and cash ratios. So ROE is, one of the most important components when it comes to maximizing shareholders' wealth, and also, understanding and analyzing if a company is how a company is valued. Let me say, so Johnson & Johnson had the highest ROE ratio out of all 5 companies, which it was 23.37 in the year of 2017, which was a year ago. Johnson & Johnson had an EVA, the highest out of all competitors, in 2013. That was 10,364.9. And basically, EVA basically compares net operating profits to total cost of capital. So the EVA, its highest EVA, was substantially, higher compared to competitors, but this ratio dropped drastically in the past years to a negative 3,690.2 in 2018. Now, a negative EVA isn't really that great of a thing for a company. Negative EVA signal that the firm, is having trouble generating, the assets that were invested into its company. Although Johnson & Johnson, had a negative EVA, and that wasn't a good sign for the company, it did substantially better as far as handling its investments compared to competitors, because, the other competitors, their EVAs were found to be consistently negative, as far as the 5, analyzing each company over the 5-year period. So that just showed me that Johnson & Johnson as a whole, they did a better job as far as that goes, as handling their investments. So Johnson & Johnson had a pretty high PE ratio. Its ratio was 16.77 in 2013, and it reached its peak in 2017 to 21.85. Now, ideally, we know that the rule of thumb states that a good benchmark for PE ratios should be 15. Anything under 15 basically signals that the company is undervalued. Above 15, that states that the company is overvalued. So then I looked at its market to book, which is basically comparing, the company's value compared to its market, value. So rule of thumb states that market to book should be under 1.1. Rule of thumb states that 1.5 is the rule of thumb for market to book. So Johnson & Johnson's market to book ratio was the best in 2013 at being 3.52, which was the lowest in the past 5 years. Although the company, showed some pricing inefficiencies, as far as being overpriced. I think that it was valued substantially lower than some of its, competitors in the field, such as Penumbra, whose PE ratio was 504.33 in 2015. That's substantially high. The firm also had a market book value of 13.29. So, I just want to say that although Johnson & Johnson didn't blow its competitors, out of the water as far as its ratios and numbers go, I've still found Johnson & Johnson to be a highly profitable company just because it showed that there was still room for improvement, but they still had opportunity to, grow, because as far as competing against the others that were in the industry, Johnson & Johnson weren't, too far off as far as the companies that had better, ratios in other areas. So Johnson & Johnson for me would be the most attractive company compared to others, because it proved for me to be the most profitable, just because I feel that the company will, experience substantial growth in the near future. So this is my presentation on my Southside report and the company that I would invest in.